Hey, welcome to the Airway Roundtable. Today's the 4th of May, 2022. Welcome, everyone. I have a special friend, Luc Van Hof. Luc and I have known each other for several years. My wife, Gabby's from Belgium, and Luc lives in Belgium. And every time we went there, we tried to have dinner or get together. COVID kind of interrupted our plans, but Luc and I have known each other a long time. Luc's a great guy, former Morgan Stanley floor trader, tons of experience, and yeah, it's great to have you on a roundtable, Luc. So welcome.
Thank you, Tom. Thank you. Pleasure to be here.
So before we get too far into it, just the normal disclosure that Airway is not a broker dealer or an investment advisor. It's for educational purposes only. Options, futures, bonds, and currencies involve risks that are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole disclosure, just pause the recording or go to the bottom of any of our web pages.
Well, welcome everyone. It's a pleasure to be here. And Tom asked me during one of our long lunches or dinners if we could maybe share some experiences with what I've been doing over the past, I should say, 30 years. Actually, at the end of the last slide, I've not included it here, but you will see more details with regard to my curriculum. But the 30-second synopsis probably would be something like I've been trading for a long time, mainly options and futures at the Bankers Trust in London, at Morgan Stanley as a prop trader, where I was running the S&P book, options and futures. And in the early 90s, I set up my own company as a hedge fund, which I then later sold to Robeco. So it was a 300 million plus CTA, which was specialized in option trading and futures trading. And after that, after I sold the company, I couldn't really stop trading, so to speak. And I basically set up a small version of AIM trading, of analytic investment management, called Capital Hedge. And it is in this capacity that I'm basically advising institutional clients, institutional investors with regard to options and futures trading. But so today, what I'm going to try and present is what I call the Enigma trading system. And the Enigma trading system is a directional trading system. So it's only using futures. It's not using options. And I know most of you people are very active in the options trading business. So am I actually. But for directional trading, I think it's very difficult to beat plain vanilla futures trading. And of course, I don't know to what extent what I'm going to tell is going to be useful for you, but I can tell you that the many investors and traders that I've been informed about the trading system Enigma seem to like it quite a lot, because it's really helping them in terms of trying to decide what kind of directional bias, what directional price movement is actually happening and what can be expected. So without further ado, I'm going to go into more details with regard to today's presentation. So on the agenda, I basically have several topics like what's behind the system, what's the driving strategy behind it, the philosophy, the risk management, performance data, but most importantly, I think also some trade examples, which show clearly, I hope, what kind of moves can be captured and what kind of moves probably are problematic for the system, because as we all know, not a single system is perfect. Holy grails, to my knowledge, don't exist. And so that's why we have to try and come up with a decent system. And I hope you like what I'm going to show you. So first of all is, of course, the important feature. What is the investment philosophy which is behind the system? Now, for me, trading is, as I say here, is essentially an exercise in managing what you don't know. There is so much you don't know in terms of news, in terms of new developments, in terms of price reactions at certain points in time, that it's really a question of being prepared to play it safe. And that's why the system is also very risk averse and tries to avoid big drawdowns. But most importantly, I think, is that for a good trading system to be reliable, it is really important that what you trade is something that has been tested. And so everything that we do in terms of trading is strictly research-based. So it's either proven that it works, and of course you want to avoid anything that doesn't seem to be working even in back tests. So it's really important that try to test as much as possible in terms of what you're trying to achieve and what you're trying to prove. Without that, it's a very difficult thing to do. Now, at the very core of the system is, of course, the notion that markets are not fully efficient. If markets would be really perfectly efficient, as according to Fama, who actually, by the way, received the Nobel Prize in 2013 for that efficient market hypothesis that he brought out, then of course it would be very difficult to make money if the market would be all the time really efficiently priced. Now, funny enough, in the same year that Eugene Fama received the Nobel Prize for Economics 2013, was another person, Robert Shiller, who is to be considered the father of behavioral economics, who said the exact opposite. He said, well, actually, markets are totally inefficient. And of course, that also can't be true. So neither of the two is fully correct, for the simple reason, if markets would be fully efficient, it would make no sense to try and beat the market because everything is already in the price, which of course is not the case. And one could ask the question, then why would any active investor try to do something? Now, secondly, with regard to the imperfection, so the market being inefficient, that's also not true. Because if it were totally inefficient, then it would be very easy. In other words, a market being totally inefficient in a certain sense means that what is being traded is totally independent of its fundamental value. So the markets would be, price would be bouncing around without any relationship whatsoever to fundamental value. And that, of course, would make it very easy to beat the market. So as we all know, it's a very, very competitive place, the market. So we can't really say that the market is efficient, nor can we say it's inefficient. So a lot of people call it actually efficiently inefficient. So it's inefficient to a certain degree. It's inefficient enough so that people who have some kind of knowledge or have found the system or discovered some things about the market can make money, and they actually provide a service to that extent. But it can't be too inefficient, because if not, it would invite too many people to try and join the race. And of course, it would basically destroy the advantage. So I think it's somewhere in between. And what we try to do, and this has been proven by plenty of academic studies, that there are different so-called anomalies, inefficiencies in the market that are there nearly on a permanent basis. And they can be caused either by the market not noticing something, which is what usually is described as an inefficiency, or by a simple risk premia. And the risk premia is nothing more than an additional compensation for having taken some risks that other people want to transfer. And that can be mispriced at some point in time. And these kind of categories are basically the basis to create so-called momentum-driven or momentum-based trading systems. And that's exactly what I've been doing for the last 20, 25 years, trying to detect trends and then try to exploit these trends using some rules, some systematic patterns and models. Now, in a simple scheme, we could say, well, it's a four-step phase, four-step process. The first phase basically is trying to detect these kind of imperfections or inefficiencies. So that's really the research portion. After one has finished the research portion and thinks that he or she has detected some market anomaly, then it needs to be tested. It needs to be proven. So that's where the statistical portion comes in. And you need to try and find some empirical proof, empirical evidence that it really is there, and is there hopefully on a recurring and on a regular basis. Once you know that, then it becomes challenging to try and build a rule-based system. In other words, an algo that is going to test these empirical findings. So in other words, you try to build an algo, a set of rules that is going to go through the whole database, trying to see how often, when, and how much profit or loss can be generated by simply implementing this market anomaly that you may have detected. So these first three steps usually are not extremely difficult. So many people find or detect market anomalies. They do some statistical testing and seem to find some confirmation that it's really there. and then they can try to build some rules, and hopefully it works as well. But if you then try to build it in such a way that it becomes scalable, in other words, it can be traded on a one contract basis, but if you would try to do say 50 or 100 contracts, it could become very difficult. So the sizing of the position can be really very tricky. So many of the ideas that we've tried and tested over the years usually pass the first 2 or 3 phases, but then fail in the 4th phase, when if you want to scale it up and try to build a position which is really potentially impacting your portfolio, then it becomes very tricky. But nevertheless, that's like the global overview of what Enigma is all about, trying to find some alpha, some structural alpha, in other words, something which is on a recurring basis available. Now, for what concerns the algos and signals, I think all of us can agree that it's really important to be aware of the fact that it's virtually impossible to come up with a single trading rule or a single simple system or method or approach or whatever that will become profitable and will trade the markets in an efficient way and with a very nice risk-adjusted return. So it's virtually impossible that something like that exists. So instead of trying to shoot and trying to find the holy grail system, it's better to diversify the portfolio, as we all know, and come up with a bunch of systems that hopefully are complementary. And actually in the Enigma system, what I've done is I've isolated 3 totally separate engines or algos. Each have their own specific approach. They all trade a different time frame. And by combining these 3 different portions with specific weighting to each of the 3, we can come up with something which is really robust, as you will see, I hope. Now, the Enigma trading signals are really designed for the US market. So it doesn't really work very well. I've tested it and even traded it on the Euro Stoxx futures. I've tested it on other markets, but it's really shining and quite nicely actually on the S&P. So I've been trading S&P since the 1990s, early 1990s, E-mini since the mid-90s when they started to become liquid enough to trade. And since a couple of years now, we also have the Micro E-minis, which are really interesting because it gives some granular perspective, and people with a relatively modest account can also trade the S&P without having to see these huge swings in their account. Now, for this trade alert service, I think it's conservative and probably advisable to suggest something like a 25,000 planned capital account for one tranche. And what actually consists of one tranche, I will explain in a moment. But so in essence, we have these 3 different trade engines that will be combined. Each of them is really very specific in terms of trading a peculiar approach, could be contrarian, could be trend following or whatever, and I'll go into more details in a moment. But so the combination is really powerful. Now, what are these 3 algos? The first one, and I think that's definitely the most important one, which is also reflected by the fact that it's getting the biggest weight in the portfolio. As you see, the trade size for these signals is 3 units. So it's the so-called momentum algo. And as the word implies, it is simply trying to identify some directional movement with a clear trend. And the trend could be up or could be down, could be bullish or could be bearish. And so it simply generates a signal to say, well, the market is going up, we need to go and be long. So it's a long entry signal. And when the move is apparently over or seems to be over, according to the model, of course, then we have a long exit signal, and vice versa. When there is some clear bearish directional movement, we could have a short entry, which then usually is followed by a short exit. And sometimes even during the same day, as we've seen lately, we could actually reverse from a short entry to a short exit and then into a long entry. But all in all, it's a very simple, plain vanilla trend following system. It holds trades on average for 5 days. So it's not extremely long term, but it's definitely not an intraday trading system, although it's looking at the market on a short time frame. And it uses the daily time frame to basically consolidate all the different data blocks, which are actually volatility-based data blocks, and then actually determines if it's worth generating a trading signal using that momentum algo. So that's the first component. And we'll see examples of it later in the presentation. Now, the second one is maybe a bit strange to most people. Why? Because it's using a lot of operational research, and it basically deals with so-called what we call classification problems. And it uses a two-layer decision model. First of all, it will try to determine if the market is in a state which could be considered up or down. But not only that, it also has to pass a certain bias threshold. So it needs to be strongly up or strongly down before we can actually pay any attention to it. And by the way, this is really looking on a very small time frame, so intraday time frames, to determine if we have this strong upward or strong downward move. And then once it has passed that criterion, in other words, it's beyond the threshold, then it needs to get some additional confirmation, and that's a very interesting filter, to then say, well, although it may be an up move, it's not strong enough, so it's a not to buy situation, while if it's really confirmed later on during the same day, then it will be considered a pure buy signal. So to be clear, it only will consider long signals. So it's not going to be very effective on the short trades. And there are many reasons for that. But one of the main reasons is that the strongest and the quickest and the fiercest up moves are usually the easiest to trade. And they could be in an overall downtrend, as we've seen lately. For example, a couple of days ago, we had this very strong up rally, which is like a snapback rally, while we are clearly still in a downward move price-wise. But these kind of very quick and strong up moves can be profitable to trade. And that's what we try and find with the second algo, the so-called bias algo. Now, the size is slightly smaller. It's only 2 units compared to the 3 units from the momentum one. And it's also more selective. On the contrary, it's holding positions slightly longer. And that's also a bit contradictory because it's looking at a very small time frame compared to the momentum algo. But at the same time, this one, the bias algo, is holding the position slightly longer. Instead of 5 days, it's more towards 6-7 days that it's holding the position before exiting. Then the third component, and the last one, is actually the most interesting one. And it's a bit surprising maybe, but it's always in the market. So it's really a binary classification problem where we say, well, is the market up or down? And it's not only enough to determine if the market is going to be up or down, but it also needs to find and detect some extreme price moves. In other words, it tries to see if there is a potential for so-called tail risk events. So 2 sigma, 3 sigma events that could take place over the next couple of hours, if not days. When that's the case, it's probably going to say, well, we need to take the other side. Why? Because the other algos, algo number 1, the momentum, or algo number 2, the bias algo, probably and most likely will already be positioned long. So then I'm actually going to go short. So it's actually hedging off or taking profits, as you wish, some of the profits that could have been built by the other algos. Now, this one, as I said, is always in the market. So it's never exiting. It's a pure so-called reversal system. So it will fire either a long hedge signal, which basically means if we are flat when we start the trading, it can go long, or when we are short from before and we have this long hedge signal, it will actually reverse from net short to net long, and vice versa. When we are currently long and we then see a short hedge signal, then of course we need to sell 2 units to get out of the long trade and then into a net short position. And it also uses the daily time frame. So in other words, we have 3 combinations that are possible with 3 algos. And of course, this in its combination can result in a pretty substantial position if assume they all point into the same direction, which does happen, as you see in the chart below, in the table below. In other words, we spoke earlier about the Enigma tranche. Now, an Enigma tranche simply means that we activate the three algos at the indicated trade size. And the indicated trade size is 1 unit for the hedge, 2 units for the bias, and 3 units for the momentum algo. So it could be, if all three go long, and that can happen occasionally, not very frequently, but it does happen, then we could be long 6 units. And if we trade, for example, 1 micro ES, then we could be long 6 micro ES mini micro futures. If on the other hand, we could see the maximum or the biggest short position, that could only be when both the momentum algo is short. Of course, that will result in -3 units being short with the momentum. And if at the same time, for whatever reason, from before or from the same day, the hedging would also indicate that it is time to actually go short, we could in total be short 4 units. So in other words, independent of what is happening, we will always be positioned on a scale from -4 units, extreme shorts, to +6, extremely long. And below you see the frequency distribution since January 2006, the day when we started trading the strategy. Now, what is kind of remarkable is that, of course, there is this natural bias towards the long side. And if you look at it, you see that about 56% of trading days, we will have a position of at least 2 futures long, which is the case when we're actually long 2, long 3, long 4, long 6. We can't be long 5. And why not long 5? Because we can be long 3 from the momentum, we can be long 2 from the bias, and we can be long 1 from the hedge. There's no way we can be long 5. By the same token, if everything is pointing to the negative side, then all systems would be negative or flat. As we know, the second algo cannot be short, so there will be no position there, but both the momentum could be short 3 and the hedge could be short 1. So we could end up with -4. But that happens only 5% of the time, 5.1% to be precise. And so in about 28% of days, in other words, when it's -2 or -4, so 28%, 28.2 of days, we will be short 2 futures. And in about 56% of days, we will be long 2 or more futures. So around flat, -1, flat or +1 is going to be the case in about 16% of days. So it is a bit tilted to the long side, which is a good thing because on average, the market is going up. But nevertheless, this is a short-term trading strategy. Some intraday traders will, of course, consider it long-term or medium-term, as we are holding positions on average about 6 days before changing the portfolio. But all in all, we have this slightly tilt to the upside, which is reflected in the weighted average daily net position being 0.91 units. So another way of phrasing is saying, well, if you trade this system, you will be on average long nearly 1 futures contract. Now, of course, with that, we haven't really disclosed a lot. An important thing to add is the trading times. And why is that important? Because it basically indicates and reflects why it is so complementary. So not only do the 3 algos look at different time frames, look at the market in a different way, volatility-based, have a different approach, being contrarian with a hedge, being intraday trend following with a bias, with an additional filter, or slightly longer term momentum with the first algo. They also trade at different points in time during the day. In other words, you could have a day which is very bullish, and at the start of the day, maybe the momentum signal will fire. Maybe 3 hours later, you could have a signal from the bias algo, and at the end of the day, the hedge algo could generate a signal. And it's exactly that way that it works. The momentum algo is like ready to trade all day long, because at the start of a trading session, which is the moment the regular trading hours start to run at 3:30 my time, 9:30 New York time, then actually the signals are calculated for the remainder of the day. In other words, they don't change, but they're only valid for the day itself. So they are not GVC orders. And so these momentum orders, they are stop orders. They need to be placed as a stop order. And of course, when the market is reaching that level, you will be actually getting filled at market. Now with the bias algo, it's slightly different. It's looking at specific points in time at the market, and only then will it potentially make a decision to go long or to exit the long trade. As you remember, it's only taking long trades. So this will start 1 hour after the open. So it's really waiting until the market has been open for a while. And they will actually stop firing signals at 2 o'clock in the afternoon, Central Time, that is about 1 hour before the close. And again, these are day orders only. Now, the hedge is very peculiar in that sense that it will wait what has happened during the whole trading day before releasing potentially a signal. And so only at the end of the day, at 3 o'clock Chicago time, it will say, let's do something, or let's stick with the current position. And as I mentioned earlier, it's always going to be in a trade. So either it's long or it's short. It's never going to be flat. So that's for what concerns the trading times. Now, the key issue with all trading, and I'm sure all of you are very well aware of that, is that, of course, you need to have and try to find a good trading edge. Without a trading edge, you can't really make money. But even more important, I think, at least that's my opinion, is that you need a very good risk management strategy. Because without a good risk management strategy, you could actually destroy a potential edge that you have in the market. So it's really critical that risk management is really fundamental in your approach. And the way this is sometimes presented is by saying, well, risk is a choice of the trader. That's something you can determine. You can pick your risk profile. You can determine yourself how many futures contracts, how many units or whatever you're going to trade. But what you're going to make is finally going to be determined by the market. It's not your choice, but the market's choice. So for us, it's a challenge, of course, to try and build convexity into an investment strategy, but at a decent price, at a reasonable cost. So convexity, I mean, getting more and more profits by loading up when the market is really going the way you expect it, and being very conservative, or even having virtually no position when the market is really very tricky to trade. And that's why risk management is at the core of the system. And what we use in terms of risk management tools are very well-known features and concepts. There is, of course, the all-important position sizing, so don't overtrade. Do particularly good and vigilant trade management. Watch the trade, so exiting when needed. There is, of course, this built-in tail risk hedging through the hedging algo. But I think the third pointer that I mentioned is the fact that you need to diversify. And diversification can be reached through in different dimensions, so to speak. The one I particularly like is the fact that you use different methods, different approaches. Of course, you can use different instruments, but here, of course, we are focusing on just one instrument to trade, although we look at different instruments as underlying, and that could be the SPX, could be the VIX, could be the ES during the daily time frame, it could be the E-mini S&P during the day session, and so on. But then, most importantly, the time frame. So by looking at the market from a different angle, be it extremely short term with a very granular approach, or a very, call it helicopter view, of course, you get a different appreciation of what the market is doing. Is it really showing a very clean, strong uptrend on the daily time frame, and maybe it's going nowhere on the smaller time frames? So all that can result in different positions being built, and can lead, of course, to different trade sizing. And for that, we use several models like skewed and fat tail probability distributions. Now, how to structure that risk, it's really key. And of course, we are focusing on capital preservation, and that means more than anything else, preventing very big losses. And that can be done, of course, by having a hedge in place at all times. And then the second point, of course, is with regard to portfolio construction, you need to make build a portfolio that is really effectively diversified. And that doesn't mean trying to find low correlating approaches, because as most of us know, correlation is volatile. In other words, correlation is not static. It's not a stationary value. It will evolve over time. And two investment approaches that can be lowly correlated or actually have no correlation could tend to correlate very strongly during certain events in the market. So the better way, of course, is to use approaches which from the start and by definition and from a conceptual point of view already are diversifying. For example, this hedging algo by definition is going to go the other way. Only when the market is very strong, it's going to go short. Only when the market is very weak, it's going to go long. So it's definitely, and by definition, it can't do anything but diversify in comparison to the trend following or momentum-based other algos. So this diversification is really one way to structure the risk in an appropriate fashion. And then, of course, the all-important position sizing, where the key issue is how can we actually control the drawdown? Because the drawdown is, for me at least, one of the key features in appreciating or in evaluating a trading approach. Now, if you look at performance figures, and this is going back to 2006 when we have brought together these three approaches in one program, you see that the overall results can be quite good, sometimes even spectacular, depending on the spectacular moves in the market, like in 2020, which of course was extremely beneficial, and something similar, but not to the same extent, happened in 2008 and 2009 with results of 192 and 271. So that's, of course, spectacular. But of course, you have to remind yourself that it also comes at a certain price. And the price you pay for that, for these returns, is volatility. So you can't really have tremendous returns, let's say 20, 30, 40, 50%, with volatility in the low teens. That's totally absurd and unrealistic. And still, with these tremendous absolute returns and very positive returns, we still have a Sharpe ratio of, say, only 1.6. So it's not like we can boast a Sharpe ratio of 3 or 5 or whatever. It's going to be temporarily maybe exceeding 2 or even exceeding 3 for a couple of months, but then it will unfortunately fall back down towards 1.5. So the objective is actually to find a decent trading approach with the Sharpe ratio, which is at least 1. And in most years, we achieve that. Not always, but in most years. Now, the drawdown, as I said, is for me critical. And even if the return would be 100%, if the drawdown would be, say, 30, I would probably not be able to trade it for psychological reasons. Why? Because it's really tough to stomach if you see your account dropping down 30%. And then, of course, you know that you need to recover it by much more than 30%. If you drop 50%, you need a 100% return to basically get back to break even. So everyone knows this volatility tax, as it is sometimes called. So key is to keep the drawdown within certain boundaries. And the boundary for me is like not more than 20%. I know that if I'm down 20%, I need to make 25% to get back to where I started from. So I try to build a system in such a way that I'm not going to be excessively subjected to a big drawdown. So compared to the S&P, of course, it's pretty good, especially also this year. We had 3 good months. April was not so good. We lost a little bit, about 1%, but that was okay. We had a terrific month of January with about 9%, and March was nearly 13%. So that was really nice. Nevertheless, we also have sometimes months where we can lose 7% in a month, as I can show on the next slide. So this actually gives some statistics with regard to risk-adjusted performance, which I think makes more sense than talking just about numbers like on the previous slide. So you see here, the standard deviation being 39% is pretty high. And that, of course, results in a Sharpe ratio of about 1.6. The downside deviation, which is an important feature, and of course looks only at the negative months to calculate deviation, to calculate volatility of the returns, is only 15, which basically means that if we have an exceptional month in terms of return, be it very good or very bad, it's usually very good, because the downside deviation is less than half of the standard deviation. And that results, of course, in a Sortino, which is quite high, about 4. And the maximum drawdown, as I already mentioned, is about 16. And that results in a capital risk ratio of 3.83, which actually is a return divided by 16.5. The Ulster Performance Index, which basically measures the steepness of the drawdown and the time it takes to recover from a drawdown, is usually basically it's squaring the drawdowns so that it's put on the same denominator, and you can then compare different trading programs by looking at the UPI. It's decent, but it's not exceptional. And the return adjusted for drawdown is about 50%, so that's quite good. Now, positive months are there about 70% of the time. But as I mentioned, sometimes you can have a pretty lousy month, and we even had months where we were down 10%. Now, of course, the other extreme is you can have exceptional months, but I'm not counting on exceptional months. Like in March 2020, we had the best month ever. But if you take away all these, what I call outliers, you would probably see the returns drop significantly, but still have a Sharpe ratio above 1 or 1.2. Another statistic which not many people I think use is what I call the underwater after 12 months. And what does that mean? It basically says, well, take the whole history of your program and you can pick whatever date. Now, what is the likelihood that a year later from where you started, you're underwater? And that happens in about 3% of cases. So virtually independently of when you start, in 97% of cases, nearly you will be up after a year. If you go for a shorter period, of course, it becomes a much bigger number because you have only 69% of positive months. So I think that's an important statistic. Now, the recovery time is not short. Of course, the program has been built in such a way that it's not going to drag on for like years and years, but still it's nearly 1.5 years, the longest drawdown we saw to a new equity high, 17 months. So it's not very short. So people who trade this system, they're advised not to go in for 2 months or 3 months because they could be very lucky or they could be very unfortunate and see a drawdown during these 4 months or whatever. Now, some other statistical indications are, of course, the percentiles. If I look at the fifth percentile in terms of compound annualized geometric return, we have 43%. In other words, in 95% of cases, we will have a return which is exceeding 43%. Same goes for the standard deviation, which is on average 39% over the whole test period when we started trading in 2006 to April of this year. But the standard deviation, fortunately, is it's not distributed as widely as the return. And that's a typical distribution characteristic. So it's nothing spectacular for this program. On average, standard deviations are relatively stable. So they are volatile, volatility of volatility, as we call it. But the 95th percentile is only 43%. So it's not going to happen very often, only in 5% of cases, that the standard deviation is going to exceed 43%. So from that point of view, it's a pretty interesting statistic because we end up with virtually the same numbers. What does that mean? Well, that you have a Sharpe ratio of 1.01, which is the 5th percentile in terms of return, and the 95th percentile in terms of standard deviation. In other words, your Sharpe ratio would be exactly 1.01 if we have this exceptional situation. In other words, we could say, in most cases, we should see a Sharpe ratio of 1 or higher, which is actually the objective of the program. Now, why would anyone consider joining this trade alert service? It's not because Tom and I thought it could be an interesting idea to bring this together and offer this, but I think it could be extremely useful for all open-minded people who say, well, we need or we may need some help in terms of deciding, is the market rather biased to the upside or to the downside? And when should we adjust maybe our option positions? I mean, several clients use this as a filter or an additional input in terms of when to hedge or when to adjust positions. So that's one possibility. But I think mostly it can provide strong diversification to people with long equity portfolios. I think of a global ETF portfolio, for example. Such an Enigma Trade Alert service could help in taking some of the heat off in case of choppy market activity as we've seen the last couple of months. And also, of course, when there is a significant down move, it will be there shorting 4 units compared to, say, a long 1 unit on average. So it's very quick to abandon a current position in the market when the market changes. In other words, when the facts are changing, we change our opinion or we change our position. And as I mentioned before, it's pretty effective in bringing diversification to a portfolio of alternative strategies, be it options or other future strategies. Now, of course, I trade this myself for many years. I have, and I continue to do this, so that makes it easy. It's not like an additional work that I need to do. It's something I trade, so it's not a big thing for me to actually distribute the signals as well. But I think the key feature is it will really provide you with some effective downside protection. And because of its asymmetric return profile, remember the drawdown is about 16.5%. Return is somewhere around 50% on average. If I exclude the exceptional years like 2008, 9, and 20, we could be down to something like 30%, but still that's about a 2-to-1 ratio between return and maximum drawdown. So it could help a lot in terms of providing asymmetric return benefits to the portfolio. Now I've added 10 trade examples so that you can get a feel for what it really means, when it's going to change position, how often it trades, and so on. Now, I will quickly go through this, but you can basically pick any period and I can bring up the charts and let you see if you have a specific date in mind. Say, for example, I want to look at August 2015 for the bias or for the hedge or for the momentum. Just feel free and we'll take a look at the charts. But here are some interesting periods, I think. This is the recent one, so that you get a feel for what the market has done or what the system has done in the market for the last, say, 2 months. So it starts in the beginning of March 6, 7. So it went short, then had a choppy period here. And then, of course, during this rally, which started, I think, on the 15th, on a Tuesday, it reversed from short to flat to long in the same day. So it covered the short and then bought and stayed long for like 2 weeks. And towards the end of the month, exited, then went short, which was a bad trade because the market didn't continue to go up. Then the next day, unfortunately, and this happens very often, that's why the system is about correct 50% of the time and not 70 or 80% of the time. So the next day on April 5th, it went long. And during the same day, it actually had to get out of the trade. Then the day after, it went short and stayed in the short trade for a while, for about a week, and then covered. Something similar happened. It went, during that same day that it covered, it went short again. And 2 days, the market continued the next day, but not in a very confident or strong fashion. As a result, the day after, it covered the short. So you see cover, and then actually went long. So that looked okay the next day, and even at the start of the day after, so 2 days into the trade, but then the market fell out of bed, and actually I had to get out of the trade, so exit the long, sell it, and then actually go short, and then stayed in the short for like 5 days. And then again, a nasty trade happened. So unfortunately, the market, I think it was on, I think the very end of May, the 28th or the 29th, the market went strongly up. As a result, we hit the short exit level. A bit later in the day, we even reached the long entry level, but the market stopped around 4,300. And the next day we had to abandon the trade and then actually go short. And we are still short now. So that's for the last 2 months. If, of course, we look at this spectacular month of February and March 2020, when we had this incredible 100% return, because all of the systems were doing extremely well. You see that in February, we already had a long trade. So we stayed in the trade for about 10 days, then exited, re-entered long, exited the next day and went short, so reversed. We had this big down move from about 3,400 to about 3,000, exited, then some choppy action during 3-4 days, and then the big down move from this level. And for like 2 weeks, we were in the short trade. And then we covered and actually reversed to long. It was like a nearly perfect textbook case. Now, something comparable happened in the fourth quarter of 2018. As we all remember, this was a pretty nasty period from December 5, 6. The market dropped significantly. In the fourth quarter, we actually dropped down about 20% in 3 months' time. We had several trades. All the blue lines are good trades. The red dotted lines are bad trades. You see, most of them are good ones. And during this volatility crisis, which occurred at the beginning of February 2018, it was lucky enough to have picked the right direction twice. So first we were, from the beginning of 2018, we went long and exited on the 30th of January, just before the big drop, and then actually reversed here. We had some choppy action again. So we lost some money here. We lost definitely some money here. And here we had one good trade and yet another one, which was bad. So it can be all over the place, but if there is, the bottom line is, if there is a clean, decent trend, it's not going to miss it. What is going to happen on a regular basis, it will go long and then the market doesn't go long or doesn't continue. So it has to exit and maybe even reverse. Like, for example, here, it enters long, the market jumps higher. Next day, it's kind of stable and then it's not convincing, so it exits. It actually reverses then to short later in the day. You see from flat to short, and then it continues down, fine. But when it then bounces up, it's quick to exit. Then it actually goes long, which was a bad trade. But so it's not going to miss out on a big trend, on a big move, definitely. So that's important for this algo. If you look at the bias algorithm, it's much more granular, as I mentioned. So it's looking at intraday data, and it's much more selective because it has its two-layer approach. So first of all, it will determine, okay, it's going to be ready to go long potentially, but then it's waiting for additional confirmation. And you see these big dots when it's actually confirming the potentially long trade situation. But for the last couple of months, it was really poor. You see more red lines than blue lines. So it was a tough market for the shorter term second algo. We had one good trade here, but then a bad one here and another bad one there. And this one was good, but nothing spectacular. All in all, we lost money on March and definitely in April with this one. And you see here these were a couple of trades in the second half of March, which was, of course, the easy portion. When we had this very strong uptrend, when the market rallied like 11% in a couple of days, well, then it was, of course, ready to jump on the bandwagon. Here it exited too soon, but then it re-entered the next day and exited here. And here it had a third trade, actually. So it can be very quick. And if you look at the last month, so April, as I said, it was pretty bad. It went long here, exited with a loss, went long here, exited with a loss, and then actually went long here, and it also exited with a loss in early May. So we had nothing but losing trades. So it's really the combination. Some of the algos can be making money, and the others could be losing money. So, but it's the overall result, of course, that counts. Now, if you look at the hedge trades, it's a totally different picture. First of all, it's nothing but reversal trades. So as you see, it's always in the market. It's either long or short. Short, going long, going short. Very bad trade here, which is in March. Why? As we just saw on this one, you see March 16, we went long with the bias. Now, March 16, we went short. Or on the 15th, we went short with the hedge. So, of course, one is losing money, and the other one is making money. Fortunately, this is 1 unit, the other one is 2 units. So net, we make some money. But then here it's reversing. It's going short again, going long again, going short again. And these are quick trades. So buying on this day, which is the end of March, and then 2 days later exiting, reversing then, because it's always reversal, trading, and then the short trade is exited the next day and turns it into a buy trade. And here we have one of the worst trades of the last several months. So it was long from, I think it was April 5th, and then it stayed long until here when it reversed to short, and then here it went long again. So now it's still long. So which is counter to the other systems. The bias is flat for the moment. The momentum is short for the moment. So net we are short 2 contracts, 2 units. And I could show you many more, but I think that's the most important. This is actually the last slide, and I wanted to end with that one because it shows, remember this is just after the 4th quarter of 2018. So as we've seen before, like here on this momentum one, we had a terrific move. So the market went down, we profited from the down moves, and then actually we had a very nice momentum trade which lasted for several weeks from early January till like mid-February. Well, unfortunately with the hedge, we have the opposite. Why? Because of course, when there is a strong up move, it could go short, and which is exactly what happened. So around, I think it's January 10, it went short, and it unfortunately had to stay short until here. So it had a horrible trade, which of course was neutralized partially by the momentum trade and the bias trade. But it's usually so that if momentum and bias are pointing up, then in most cases, this one is actually going down. So as I showed you earlier in the presentation, you see it's pretty exceptional that they all 3 are pointing in the same direction. It happens about 16% of the time. But in many cases, like here, we could have, for example, the momentum going up, the bias going up, and one going short. So then we end up with actually 4, 3 from the momentum, 2 from the bias, and -1 from the hedge. So it can be all over the place, but the critical thing is, do we have a system which works, which delivers, which is providing a decent return for an acceptable risk? And I think that's what we try to achieve by looking at these numbers, where we say, well, of course, it's a volatile thing, but that can be tamed down. I mean, everyone can pick his own risk profile. I suggested 25,000 in terms of what I would call planned capital. But with that, I think we can trade it in a way which is really acceptable. So if you think about it in a different way, 25,000, and on average, you're long about 0.91, I think is the average. So you see here, 0.91 units, you would be long, say, 9/10 of one future. So if you think of the S&P currently around 4,200, so that means that 210,000 is the value of an S&P contract. So the micro is 21,000. So you would be long on a portfolio of 25,000 planned capital, you would be long invested with 21,000. But of course, you need to keep in mind that that 21,000 that you will be having as a long position on average can really increase dramatically, because you could be long 6. And if you're long 6 futures, it would be the equivalent of 126,000. So 21,000 times 6 So then you would compare to your 25,000 planned capital, having a leverage embedded or implied of 5-1. Vice versa, if the market is in a very strong down move, with your 25,000 planned capital, you could be short 4 contracts, which would be like 21,000 current value of the S&P times 4, which will be 84,000. So it's about a 3.3 to 1 ratio between the 84,000 and the 25,000. So it's a conservative approach, but one should always keep in mind that this leverage, of course, goes both ways. But the width or the spread between the ultimate short and the ultimate long is exactly 10 futures, 10 micro futures in this example. But that's, of course, up to everyone's risk profile to decide how many contracts you're going to trade for a certain account size. So I think with that, I've covered most of it, and I would like to open it up for questions, because I'm sure I've been talking a lot about this, but you may have many questions. Please feel free. Thank you.
Yeah, look, if you look in the chat, there's several questions for you already.
Okay. So
you have to go up to the top, and then I think you'll see the link for, it's like a button for chat on the Zoom.
Absolutely.
Yep.
So, okay, so not being able to stop trading is one of its greatest risks. Absolutely. So that's why the hedge is a very tricky algo. I fully agree. So it's, for me, psychologically, the toughest one to trade, because you're always going against the grain. Now, again, it's very exceptional, and you can see it here. It's in about 3% of cases that you will be positioned only with the hedge algo. It's very exceptional that you would be flat with the momentum and flat with the bias, and then have a signal, of course, with either +1 from the hedge. So you will always be in a position, but it's not necessarily comfortable. Then again, it's a small position. And so it usually works as, of course, as a hedge, as a, call it a profit taking or a stop loss on the other systems. So the first question I see is, might there be several buy signals during a trading day? Yes, it's very exceptional, but it could happen. But of course, it needs to be spread out in time. For example, if it would be a trade about 1 hour after the open to go long, it could exit an hour or two later. And if the market at the end of the day, again, shows very strong trending behavior to the upside, it could go long again. That's definitely true. It's possible, but it's rather exceptional. And are the returns from actual trading or backtesting? Actual trading. So it's systems that we have been trading since January 2006. What is the CAGR? Well, the CAGR, I think it's here. It's 63.4. So that's using a fee structure, and that's why I think this statistic needs to be explained a little bit more. So I've used a 25,000 planned capital, applied 3 units for the momentum, 2 for the bias, and 1 for the hedge algo. And then I applied the fee, which of course consists of the monthly payment for this trade alert service, which equates to $125 per month. In other words, it would be $1,500 per year. And that's basically the 6% of the 25,000, which is being deducted. So that's why it's a 63.4 after the fees of $125 per month. So did you try other granular weights? Yes, of course, because I try to avoid any curve fitting or any optimization. So, oh, that's something I've not mentioned. I should have mentioned that. I apologize. So each and every one of these 3 algos is parameter free. In other words, there is no momentum with a 27 moving average or a relative strength index looking at 3 to 5 ratios or a bandwidth of whatever. There is no optimization whatsoever. It's all parameter free. That's why it's pretty universal and it's pretty robust. But the fact that it's robust doesn't mean that it's going to make money all the time. but we have tried to avoid any optimization or curve fitting with inputs in the algos. Now, to answer your question more completely, I'm of the opinion that it's best to try and play this as in a simple way. And by a simple way, I would actually start off when I have a new trading idea or when we come up with a new trading approach. We could say, well, we should give this a weighting of 60% versus 40 or whatever. I think it's usually best to equiweight it. In other words, not to give a certain bias built into the system. Only when it's really important to, how shall I say, to underline the strength of a certain approach and the benefit or the relative lack of benefits of one approach in comparison to the others, that you can start playing with weights. But then I'm not going to use something a bit extravagant like, well, I use 1.72 weight for this and 2.13 for that one or whatever. So I'm simply using either a 1-1-1 or actually using the 3-2-1 or the 3-2-2 or the 2-2-1 or whatever. And I can show equity curves to those as well. Sure. I can send you those. I will send them to Tom, and that's not an issue. So instead of using the 3-2-1, which is my favorite. Why is it my favorite? For this reason. So the reward to risk ratios are by far superior. Now, I haven't shown that, but on a standalone basis, the biggest return actually can be captured with a hedge. If you would equiweight them, in other words, you give them the same weight, 1 unit each, the biggest return you can obtain with the hedge algo. However, the biggest drawdown is also with the hedge algo. So it's a question of being comfortable. And of course, if you say, well, I take a small portion of my account and I just trade the hedge algo, fine. But you can achieve better results in terms of Sharpe ratio, in terms of recovery, in terms of also performance index, if you combine them with the other algos. Now, the less interesting one, so to speak, is the second one, the bias. But then again, it's extremely selective. It's using this 2-layer approach, and it's not showing that many trading signals. The bulk of the trading signals actually come from the momentum system. The momentum algo, the first one, about 60-65% of all the trading signals are coming from that one. And so the systems are indeed, so I'm going to look at the question, understanding that the hedge is there for protection, will tend to lose on a higher percentage. Yeah. Do you have a breakup of win-loss? Yes, I do. So I can show the win-loss for the 3 algos as well. Now, surprisingly, I can actually look at it. I think I have opened the files for the 3 individual ones. Let's put one up here. So the percent profitable, I mean, you see here, this is on, I can show it to you, that's even easier. You see the percent profitable for the 662, which is actually the bias, is 45%. So it's less than 50% profitable. Now, if you look at, for example, the reward to risk ratio, and you look, for example, at the profit factor, it's about 1.7, 1.6, depending on if you're excluding outliers or not. But the average winning trade is about twice as big as the average losing trade, 1.6 compared to 3.2. If I take another one, and I'm specifically going to look at the hedge. So here we see the performance summary. You see it's profitable about 65% of the time, even 72% on the long trades and about 59% on the short trades. But look at the average winning to losing ratio. It's about 0.87. So when you lose a bit more than when you win. Here it's about 0.8, the ratio between winning trades and losing trades. And if I look at the last one, the momentum one, 172, is the one which is trading very frequently. So this is about, as the lowest ratio, as a ratio of about 41% profitable trades. But look at this, It's about 2.6, the ratio between average winning trade and average losing trade, 2.9 versus 1.1. So they all have their own characteristics, but it's really in the combination that they show their true value, I think. So are the systems fixed? Yes, they are not optimized. True. How will the service work? Will it be possible to run EL code on my TradeStation instance? No. So I will just simply send out the signals to the template that Tom has prepared. So you will get in time the actual trade levels. And indeed, it will be intraday trading signals. And at the end of every single day, there will be new trade signals. So it's not so that a signal from yesterday can be continued for the next day. Can CFDs, contracts for difference, be used? I think so, but I haven't done it. So why do I use S&P futures or micro futures? Because of course, the transaction cost and the slippage. Slippage is virtually excluded. You can count on one tick because it's an extremely liquid market. So from that point of view, it's, I think, the preferable choice. In terms of the win rate, as I said, it's really a question of the algos. It goes from 40 to about 72%. And absolutely, well, I'm not so convinced about the T-bonds. So return-wise, it does. But for me, personally, the drawdowns are too big. So you get Sharpe ratios, which are far below 1. And I feel much more comfortable with Sharpe ratios, which are 1 or above. So that's why I would not suggest it. And one of the main reasons is gap risk as well. It's not this continuous market as what we've seen on S&P. So although we are not trading 24/7, we of course can collect data tick by tick. We have a huge database going back to the 90s. And of course, then we can do much more analysis in terms of what kind of patterns are there and what kind of gaps can be expected. While if you are confronted with gaps, gap openings, I mean, then it can be pretty tricky. So I'm sure it will work to a certain extent, definitely return-wise, but not on a risk-adjusted return basis, I think. After the alert is sent, what would be the slippage to enter based on the alert? Very good question. I think, I mean, it depends again on the algo. I have to make a distinction between the three. For the first one, momentum, it's pretty easy because we know in advance when we are going to trade. In other words, at the start of the day, it could say, for example, if I look at today's trade, I can quickly tell you what we will be doing. So as I mentioned, we are currently short. We are short from a couple of days ago. And the exact level was, short entry was at 42.29. So we exited the previous long trade on the Friday at 42.49 and actually went in short about 20 points lower, 42.29. Now, the next couple of days, the short exit was far away, but yesterday we were actually quite lucky because our exit signal, and that's SPX based, was on 4201.08, and the high yesterday was 4200.1. So about 1 point away from the short exit level we went yesterday. So we are still in the trade. And today, for example, we are going to get out of the trade at 41.88. So it's really not very far away because the high was 41.85. So these levels, where will we trade for the momentum algo will be known instantly after the opening tick on the regular trading session. So when the SPX opens, it's one additional input and the system will say, you'll have to exit here or you have to enter there short or long or whatever the position is. So that's known. And as it is known instantly, it can be forwarded, it can be sent out so that you know, let's say 5 minutes after the open, okay, if we see 41.85 on the SPX, and I will put it all, of course, in futures terms so that you know exactly where to buy the future or where to sell the future. So then you know it in advance. Now for the second algo, it's even easier. Why is it even easier? Because you will know in advance if there is a potential, if there is a possibility to have a trade. If it looks at the market on the regular time frames, let's say it looks at the market every hour, if the conditions are not met and it doesn't meet this first layer criterion, so the threshold, as I explained earlier, so if it doesn't go beyond the threshold, it can't go long the next hour. So it will try again the next hour. If 1 hour later it does go beyond the threshold, then we could be prepared to potentially go long at the end of the next hour. So we know in advance if there is potentially a trade. So that will be sent out. And of course, it will be confirmed instantly at the top of the hour if the next block of data is basically being collected. So you will know it also in advance. So slippage is not going to be much of an issue. Now, the third one is a different story because we just end the day and it is at that very point in time. I mean, it's not at the last tick of the futures because it's 15 minutes earlier, but it's at the close of the cash, so the SPX. So at the top of the hour, that the signal will be delivered to say, well, are we going to reverse the position or not using the third algo? And so that will be communicated instantly. So there will be some deviation. It could be positive slippage or negative slippage. Now, historically, it's been a wash. And I'm not saying that because it sounds good, but it turns out to be the case. And if you do a quick analysis and you say, well, let's look at prices between, say, 5 minutes past the hour and the top of the hour. I mean, the 10 o'clock at night for me, my time. So 3 o'clock in Chicago at the clock, at the moment that the SPX closes, the cash closes. And you look at the 5 minutes afterwards, sometimes it's higher, sometimes it's lower. And all in all, it basically boils down to a zero operation. So I don't think there will be a lot of slippage. So I reckon that there could be slippage of 1 tick on the entry, 1 tick on the exit compared to the indicated level. But in most cases, I get filled at the level.
Look, just a quick question. Are you putting in market orders or limit orders?
No, it's market orders.
Market orders,
so
okay.
I think I mentioned it in the slides. So,
I must have missed it, sorry.
Yeah, so you see here, but the MOM algo, all momentum orders are to be placed and execute as stop. But for the bias, it's market order. And for the hedge, also market order.
Great.
See? So it's only for this one because we know in advance where we are going to trade. Here we don't know, but we know in advance, but not the price. Here we know the price, we don't know the time. So the momentum is in a way the easiest. We know at the start of the day, okay, there will be a trade if and when we reach this level or that level. With these ones, we don't know because there could be an indication that there could be a signal, but then it requires this second layer confirmation. And for this one, we don't know anything until at the very close of the trading day.
And the bias, so those are only updated on the hour?
Yeah, absolutely. Absolutely. Yeah. To make it easy.
So if there's no trade at 11, you can wait till 12.
Exactly. So it's either at 11 or it's at 12, but it can't be at 17 minutes past 11, unless it's, of course, from this one.
Right, but that's a predefined order. Yeah.
Absolutely. So that's a predefined price level, and these are really time-based. Okay. It can be used for SPY, definitely. Same thing. You can trade SPY as well instead of trading futures.
How would you convert the futures to SPDR if you're going to trade it with SPY?
Oh, very easily. You can go long and short using 1 SPY equivalent to basically 1 micro, or two micro ES. Because 1 SPX equals 10 SPYs, 2 ES equals 1 SPX. Hence, you can use 2 micro ES for one SPY. So if you would be trading one SPY instead of one micro, you would be trading everything at twice the size. So it would be slightly more aggressive, actually twice, leveraged twice compared to the 1 unit, 2 unit, 3 units of the micro futures. But it's definitely doable. It doesn't really require extensive screen time, because with the first momentum algo, you just place the order if you wish. You say, well, this is what I'm going to buy or sell. And it's done for the day. It's actually how I do it. I place the order and I don't even look at it. I will see it when it's filled. And for the others, of course, then I need screen time. In other words, I will get a message when there is a potential trade with the bias algo. And at the end of the day, I'm always there to see if there is a trade or not using the hedge. So there is some screen time, definitely. You need to be around for the second. You don't need to be in front of your screen. You could just receive the message and then say, well, I need to buy because of the bias algo at, say, 2 o'clock in the afternoon. That could happen. Or at 3 o'clock in the afternoon, at the close of day, you need to reverse using the hedge algo. You don't need to be in front of the screen, but you need to be able to trade intraday. That's correct. No, it's the question from Ajay. I'm still confused how the signal works. Automated trade or user has to place the trade? The user has to place the trade. Yeah.
I replied to that one. Yeah.
Okay, I'm sorry. I didn't see that. I'm glad we're giving the same answer, Tom.
Yeah.
Okay. Please give on information on how transition on futures contract will be handled. Good question. So it does happen, of course. And if that, we usually transfer on the Thursday before, when it's a step-up day, so to speak, when the next contract becomes the front month, then we will change into the next contract. In other words, the Thursday before the expiration of the June contract, so usually the second Thursday of the month, and assuming we would be in a position at that point in time, we would switch from June to September. So it will happen 4 times a year, potentially, if you're in a trade. But that's exactly what we need to do. So it's usually the day when the liquidity turns over from one contract being the most liquid to the next one. So it's usually on the Thursday or the Friday. And for simplicity's sake, we don't trade on the Friday because it's pretty hectic. We trade that on the Thursday, which is the so-called step-up day for the futures. And then we would roll the futures position, if there is a futures position at that point in time, from one contract to the next. What do you do for vacation? A lot. I try to enjoy it.
No. I think his question, how do you trade while you're on vacation?
Of course. Yeah. So no, I have an assistant who takes over for me. So from that point of view, it's not an issue. What's the win rate of the MOM system? Well, I think I showed it's about 40%. So it's surprisingly low. I'll show it again here.
But the profit factor makes up for it.
Yeah, it's about 41%. So 35.5% for the short trades, 46% for the long trades. But the profit factor is pretty decent. It's about 1.8. And I think that was the last question.
It looks like the last one, yep.
Okay.
The second half of May will be open to everyone, a free charter trial for the second half of May, and then 1st of June, the paid service at $125 a month will start. So that's kind of the pacing of things.
Absolutely.
All right. Well, it looks like a really great way to trade. Nice, diversified, great risk management. So Luc's been doing this a long time, and it's you can tell with the data that he has. It's very detailed, and he's very analytic. So I've always appreciated that, and have a lot of respect for Luc. So Luc, I hope it works out as a great success. And thank you very much for the presentation, and thanks everyone for attending.
Pleasure. I hope it was useful, and it could maybe help you in helping to determine the directional movement in the market, because it can be volatile, as we all know.
Okay. Well, thanks everyone. Thanks, Luc, and we will see you next time.
Thank you. Bye-bye.